Hey there, fabulous financiers. Welcome back to another episode of Do Different Better, where we talk about wealth wisdom and money moves, making finance simple for everyday people. I'm your host, Elaine Rasmussen, CEO and founder of Social Impact Now, Connect Up Institute, and managing director of the Integrated Capital Fund. Thank you for joining me today. Today, we're diving into a topic that's not just about money, but also about making a major impact. We're talking about angel investing, a powerful way to support startups and emerging companies while potentially growing your own wealth. Whether you're curious about getting started as an angel investor or you just want to know more about how investments work, this is the episode for you. Let's get into it. So, all right, let's kick things off by just starting with the basics. So, what exactly is angel investing? Well, simply put, angel investing is when an individual invests their own money into a startup or early stage company in exchange for equity or ownership in that company. Think of it as being one of the first believers in a business that has the potential to grow big, which is different from a customer, but sometimes customers turn into angel investors, especially those early customers. These early stage investments are really important and crucial for startups because they often give them the capital that they need to really get the business off the ground, or sometimes even just getting the product launched. But it lets them hire some key team members and really set the foundation to scale the business. So, let's be clear, let's define angel investing. It's all about providing early stage capital to companies that are just starting out. It's different than venture capital. Venture capital is usually that there is someone or a group of people that are managing a large fund that invests other people's monies. Angel investors usually are investing their own money. So when we talk about venture capital, we talk about private equity, and we've talked about those in previous episodes. Those are either one of two things: a pool of a bunch of investors' money, or it is a fund of funds, meaning a fund that actually invests in other funds who do that kind of investing. But the objective is that all that money is pooled together to get larger dollars amount, as opposed to angel investing. You might be just going in alone, or you might be in an angel investing group, and we'll talk about that in just a few moments. So, why are angel investors important? Why do they matter? Well, startups and small businesses live off of innovation, and they need to grow. They create jobs, they disrupt industries, and they bring new ideas to life. Without angel investors willing to take risk on these early stage companies, many of the products and services we use today might never have come into to exist. So just think about some of the biggest companies today, like take Google or Facebook or even YouTube. They all started with angel investors who believed in the vision of the founders and they were willing to take a chance. Without those early investments, I might not be here talking to you today. But it's also good not just for large companies such as the Googles and the Facebooks, but some of the small companies that right are in your own backyard. Giving them that sort of believe in you money, as my friend Jessica Norwood likes to say, is so powerful to help them get to the next level, to really grow, hire their first employee, build their prototype. So don't underestimate the value of even what a small investment could make into a local small business. Now, let's talk about the different kinds of angel investors. Now that we've talked about what angel investing is and why it's important, I'm now going to break down like what kind of angels are there, because they're not all built the same. So, first, there's individual angels. These are people like you and me. Maybe they have a little bit more disposable income, but not necessarily. But these are folks who decide to invest in a startup using their own money. This includes individual angels often have a passion for entrepreneurship. Maybe they have always wanted to be an entrepreneur, but they know that they don't have the stomach to be an entrepreneur. or they just really find the whole thing inciting. They want to give back to their local community or to another small business because they started off as a small business, or they might be looking for a high return on investment. They could be former entrepreneurs or maybe professionals who have built up a large stable of wealth and are really looking to invest in others. Individuals, so you might be asking, like, why would anybody want to do this? Or you might be a small business of why would an angel want to invest in me? Well, individual angels are often motivated by more than just a financial return. Many enjoy mentoring young entrepreneurs, sharing their expertise, helping to shape the future of a business that they believe in. It's not just about the money, but it's also about making a difference. Sometimes they want to share their network. Maybe they're really connected. They have a really deep knowledge in a particular specific expertise, and you know that your expertise would be really super helpful to a small business. So that's the first kind of angel investor, an individual. Then we have angel networks. So these are groups of angel investors who pool their resources to make larger investments in the startups. By working together, they can spread the risk across multiple investments and increase their impact, but also lessen their individual risk because they're not making decisions alone. The decisions are being informed by the group, but also by additional research and other supports. But it's a really great to be part of a team, and only this team is helping to launch the next big thing. But also this team is that they have the benefit of each other to be look out for things that maybe you wouldn't have seen if you had just been an angel investor. It also allows people who maybe have a smaller amount of capital but really want to get into investing, on angel investing. It's a great place to start. So you might have $1,000 that you're looking to invest. By pooling it with other people, you can make a $25,000 investment, right? So no amount is too small and no amount is too large to go and become an angel investor. So here's just a fun fact. Some of the biggest names in tech started with angel funding, right? So if you're talking about Airbnb, you're talking about Lyft, many of these what are now large companies and household names started off, even Amazon started off using angel investors to get off the ground. So whether you are an individual investor or you are part of a network, the goal is the same. You are looking to support innovation, or you're really looking to support local businesses in your own community. And ideally, you'd like to make a return. But you really need to know about the risk and rewards of really getting into investing as an angel, because there are risks, right? Even as an angel network, there is some downside that you need to be aware of. So, but we're going to talk a little bit more about that in the next segment. But for right now, I'm going to give you some practical and tactical tips. So you might be thinking, wow, Elaine, this sounds so amazing, but how would I actually even get started? Well, that's okay. I've got you covered. Here are some practical steps that you can start thinking about and considering if you might be interested in becoming an angel investor. So the first thing that I'm going to tell you to do, as always, is do your homework. Research local and online angel investor networks. I'm here in Minnesota. We have a number of groups that are angel investor networks. Some of them will allow you to join their meetups. Sometimes they have meetups that are open to the public for people who are new, or if they're looking for new angels. There was an organization that was called Social Venture Networks. I think they're still around in some capacity, but once again, this was a group of folks that would get together, invest, pool their money to make a larger size $25,000 to $50,000 investment in a local business that they thought was a really great idea. Sometimes you hear angel investors are connected with tech companies, but that doesn't have to be the case. You can invest in, if there's a local coffee shop, especially if you live in a smaller rural community. It is not often that angel networks will be to gather people together into an angel network to support and grow a local business, a local small business. But these networks can be super, super valuable around having resources, connections, and opportunities to learn from more experienced investors that may be more difficult to you to do just on your own. There's also websites like AngelList, Seed Invest, and Gus, which are also great places digitally online to start looking for investment opportunities, or if you just want to learn more about the process and what you should be aware of. But once again, the first step is do your research to find out some other angel networks. There's another great angel network that I highly recommend that's specifically for women of color, and that is Pipeline Angels. They actually have a great education series. There's also, I believe it's the Angel Capital Association, ACA. They are also another group. They're a national group that is comprised of local nodes of angel investors, but they have an annual conference. So you might want to just take this next maybe 3 to 6 months and really start to learn and meet some other people, hear their wonderful stories, but also hear their horror stories to find out really if this is something that's for you. So that was step one, research, research, research. Step two, think about the industries or types of businesses you're passionate about. Do you love tech? Do you love healthcare? Or perhaps you're really interested in supporting a um, a a business owned by a person of color. Maybe you're really interested in supporting a woman-owned business or a young person business. The beauty of an angel investing is that you can choose to invest in the areas that matter to you and that you have expertise in. This not only makes the process more enjoyable, but also aligns your investments with your values. One thing I always tell people who are interested in doing angel investing, and I've done some of my own angel investing, these were definitely, I chose to invest in people that I had some sort of previous relationship with before the business started. So I had some idea of not only their character, but how they operated. I also look for people who I feel are coachable. While I don't have all the answers, I do have some life experience. But I think it's really important if you're considering to be an angel investor to really think about how much time do you have? Do you want to be a mentor or do you just want to be an investor? Do you have some expertise that you want to give, or are you wanting to invest in that because you want to learn more about that particular sector or industry or whatever the case may be is? But the more clear you can be about your why, the more clear you can be about what you have to offer, not only financially, but in some of your other resources. Do you have networks that you can bring to the table to support this small business or this growing business? Do you have other sorts of capital? Maybe it's political capital, maybe it's something else, that some kind of expertise that you have that is uniquely that you can bring to the table. I would definitely encourage you to take an inventory of all of those things, so that as you're having conversations either in your angel group or if you're kind of softly talking to a potential investee, that you at least are coming to the conversation with some thoughts and not just kind of like emotionally vomiting all over the person about what you're thinking, and you're putting it on them to kind of figure out where there might be alignment. You've actually kind of thought through that and figured some things out. So step one, research. Step two, think about and take an inventory of your passions and interests and what you actually have to offer to a small business. Now, step three is your call to action. So this is really, it's getting started. So some of the things that you can do to continue and encourage your learning is attend pitch events, right? I believe Million Cups, I think they're offered all over the country. It's free. They're usually on the same day of the week, same day, same time, same location. And you can hear different kinds of businesses. They're doing it because they're looking to perfect their pitch. So you might see the same ones over time. You might see different ones every week, but the whole idea is you get to hear some of the things. And like anything, the more exposure you have to it, the more oriented you're going to be, you're going to have to the conversation and what kinds of things pop up. But also you get to hear what questions other people have. There's lots of webinars. There's also virtual pitch fests that happen. But you can even take a course on angel investing. I think Coursera and maybe LinkedIn. I know there are some of the local colleges and universities that might be near you. You can go and take a class, whether it be audited or for free, or that has a nominal fee, or it might be part of their continuing education, or it might be a part of their executive leadership education at many colleges around the country. But the more you know, the better prepared you'll be to make informed decisions. But also, these are great opportunities to start building your network. This gives you an opportunity to connect with other investors by attending startup events. In Minnesota, we have Twin Cities Startup Week. I know there's startup weeks in other states, but attend the startup week in as much as your schedule allows. You'll get to meet investors, you'll get to meet businesses, and you'll get to meet the larger ecosystem, because that's also valuable, important as well. So you can know where people, places, and spaces that you can plug into. So that's your homework. Start by just exploring the world of angel investing. And if you're already investing, consider sharing your experiences with others who might be interested. Maybe you hold a brown bag lunch at your company to say, I'm going to be hosting conversations on angel investing, and I'm going to be telling my story about angel investing. But the thing to remember is angel investing is not just about making money. It's also about building something stronger than yourself and supporting the next generation of businesses and entrepreneurs in your community. So that wraps up our first segment on understanding angel investment. And in the next segment, we're going to dive into the process of finding and evaluating investment opportunities, structuring your deals, and more. So stay tuned and don't forget to subscribe. Leave me a review and share this episode with anyone you think is curious about angel investing. I'll see you in the next segment. Welcome back to the Do Different Better show, where we're breaking down the world of angel investing. In our first segment, we covered the basics. What is angel investing, different types of angel investors, and how to start exploring this exciting way to support startups. Now it's time to go deep into the process. We're going to talk about how to find and evaluate investment opportunities, structuring the deals, and what to look out for along the way. So let's get into it. So you say, Elaine, I'm interested in angel investing. But the big question is, where do I find these investing opportunities? They're not just knocking on my door, and I'm not using the places and spaces where people would know to tell me that they're interested in me investing in them. Well, it's not like startups are hanging out on a corner and waiting for you to say, hey, I want to invest. Well, not usually anyways. So the first thing we're going to talk about is deal sourcing. Deal sourcing is the process of finding potential investments, and there are several ways to go about it. One of the ways to go about it is that you can go to pitch events. These are events that are hosted by startup incubators, accelerators, and investor networks. And it's a great way to meet entrepreneurs who are looking for funding. I know locally here, we have University of St. Thomas. They have the Fowler Challenge competition. I've been a judge, I think now 3 or 4 years in a row. And so it's a great opportunity to kind of see what are young people thinking about, what's exciting to them, what innovations are they working on, or how are they thinking about the world. It's super, super exciting. So like what happens at a pitch event? So imagine that you're attending a pitch event at a local startup incubator. You're going to listen to a lot of entrepreneurs who present their ideas. And if one piques your interest, you can start a conversation with them right then and there. It's really a good way to get a feel for the passion behind the business with the founder and ask them at least some initial questions. Now, the goal is not that you're going to take out your checkbook and write them a check that day in that moment, but the whole idea is you're getting comfortable with not only whether you're a seasoned investor or a new investor. Very rarely, if at all, does somebody go to a pitch event and write a check. It's not Shark Tank. at all, that could be nothing further than the truth. And if you really know the behind the scenes of Shark Tank, that hour show that you watch is at least 4 hours of filming that goes into place. And there's a lot of work that happens before then, and there's a lot of work that happens after that. So, don't get feel pressure that if you go to a pitch event that you're obligated to write a check. Nothing could be further from the truth. No one is expecting that, least of all the entrepreneurs. But you know what? If you got a couple $100 and you want to write them a check, that's also cool too. They will not turn it down. They need that sort of inspiration that somebody believes in them. Like once again, my friend Jessica Norwood, she really talks about the story of her grandmother giving her "Believe in you" money. I believe in you. So it's really great, especially if you have that discretionary income. The second way is to go into online platforms. So another way that you can find folks is by going on. There's AngelList. I think there's Abaca, which is supported by Village Capital. There's Seed Invest, and there's Gust. I think there's Techstars. There's so many out there. You just put into Google platforms that have lists of small businesses or tech businesses. Now, many of these platforms often relate to tech-based businesses. So if you're really looking to invest in something that's more local, that's more tangible, maybe you're like, I know nothing about tech. I'm really not interested in supporting or investing in a tech business at this moment. I really am interested in like a local, hyper local business. Maybe it's an upstart artisan gift shop. Maybe it's an upstart coffee shop. Maybe it's an upstart brewery. Whatever those things are, maybe it's a halal grocery store. Whatever those things are, maybe you're really focused on hyper local. So if that's the case, many of those folks are not going to be on these platforms. If you're really interested in those kinds of folks, then I really encourage you to seek out your incubators and accelerators that are local to you. They are going to have their finger on the pulse of where some of those alternative small businesses or non-tech related small business, like your consumer packaged goods. I always tell folks when we talk about scaling and we talk about big business, I often get into conversations, particularly with investors talking about, well, I want to scale it. I want to invest in a high growth business. And I really want more people to invest in consumer packaged goods companies, because consumer packaged goods companies aren't big until they're big. Right. So I always like to, I'm a 70s, 80s baby. So I remember Paul Mitchell and Vidal Sassoon. They were hairdressers before they were mega mogul hairstyling and shampoo and conditioner companies, right? They had salons, and they started with one salon, then two salons, then three salons, and then started making their own products, and then started selling their own products, and then just got bigger and bigger and bigger and added on to different product lines from there. But they weren't big until they were big. Same thing with Shea Moisture. While I don't believe the founder, Rich, was a hairstylist, but it really was started as a small company, very small company, and then just grew and grew and grew. And now it is a multinational company. And so that has made him a multimillionaire. So, these are things that you want to think about of, once again, as I talked about in the first segment, of thinking about what is the expertise that I could bring. Do I want to be investing in a company that I have some expertise in so I can support them that way? Or do I not care? Is your superpower strategy? That's one of my superpowers, is strategy. So it doesn't matter what business that I'm interested in investing in. I know that I have something to offer because I can bring them things from a strategic perspective. But just remember that they are mostly targeted towards tech-based business. That's not what you're looking for. You're looking for something local. The pitch events and the local incubators and accelerators that are in your community, those are going to be where you're going to find some of those really hidden gems that are right under your nose. But so here's a tip as it relates to the online platforms. Sign up for these platforms and just start looking around. No one can see what you're looking at. So just poke around and see what you're seeing and seeing what looks exciting, and or what are you curious about. Even if you're not ready to invest, it's a great way to see what kinds of startups are out there and what types of deals are being offered. What levels of money are they asking for, and what are they saying that they'll do with the money that they receive, the funds that they receive, or the capital investment that they receive. And then finally, there's just good old-fashioned networking. Can't say too much about that. Once again, getting involved in your local startup community, your incubators, your accelerators, your community development financial institutions, your small business development centers, the local small business association. Any of those can help you get plugged in to your local startup community. Attend the events. Many of these folks have some kind of regular convenings, whether they be workshops or an annual conference. The organization that I founded, Connect Up Institute, we have a annual convening. Actually, our convening is every 2 years. It's called the Connect Up Summit. We're actually getting ready to do a mini summit, which is a 1 day, which is called AI for Small Business Growth. So that'll be November 15th. I'll have more information on that coming up. But this is a great place for you to meet entrepreneurs that are in your local community in a no pressure, no judgment zone. But joining entrepreneur meetups and connecting with other investors is often where the best deals come from, and through your personal connections and referrals. So next is what the next step in the process. So first we talked about deal sourcing and where you can go to find the deals, so to speak, opportunities for deals. You may not pull the trigger, and that's okay. But the whole idea is that you're actually looking and getting exposed to a lot of opportunities. And the exposure is what's going to help you get more deliberate and more focused by seeing what's out there. Next step is what's called due diligence. So let's say you've found a startup that you're interested in. It's time for due diligence. This is a process of thoroughly researching and evaluating the startup before you invest. So think of it as like doing homework. You wouldn't necessarily buy a car without checking under the hood, looking at the Carfax, and you really shouldn't invest in a startup without doing your due diligence. Now, there are 3 kinds of due diligence. The first is what's called screening due diligence. You don't have to tell the founder that you're doing screening due diligence. This is a more informal process. It's really that process of you're going online, maybe you're looking at their Instagram, maybe you're looking at their website, maybe you're asking people around, maybe you're looking at you see some of their customers, or maybe you would know some of their customers because you know people who have bought their product, and you're asking around, you're trying to kind of get kicking the tires, so to speak, right? You're not necessarily ready to write the check, but you're kind of like, okay, this has piqued my interest. I want to know more. Once again, you do not necessarily need to tell the founders that, oh, I'm going through screening due diligence right now. Once again, screening due diligence is very, very informal, and it's not uncommon for screening due diligence to take a year or 2 years. I've had folks that I've co-invested with say to me, hey, I've been watching what you're doing for 2 years. Yes, they've said that to me. And they didn't approach me until 2 years after they started kind of eyeing me, checking me out, seeing what I'm doing, seeing where I'm going, seeing what kind of traction am I making. So it's very, very common for that to happen. The next part of due diligence is what's called business due diligence. And this is when you start to switch into the more formal process of due diligence. This is where you start reviewing the company's financials. You're looking at their balance sheet. You're looking at their income statements. Obviously, unless they have this information public, maybe it's on their website, which is rare, you've now begun the formal process and informed them that you could possibly be interested in investing in them. And these are documents that you will be asking of them to share with you. They more than likely might have you signed a confidentiality agreement, or they might ask you to keep their financial documents in confidence and not to share them out without their permission. A lot of founders are now a lot more sophisticated, and there's platforms like DocuSign where you're given permission to what's called a data room, which is an online sort of information office of all of the things regarding the company. They may give you access to that data room for a certain amount of time, maybe 7 to 14 days. And once that time expires, you no longer have access to their data room. If you are still wanting to review more documents or need more time, they would have to send you another link or extend your permission so that maybe for another 7 or 14 days. But once again, this is the formal process where you've now asked them for what's under the hood. I want to see your financials. You want to find out how much money are they making? How much money are they spending? Do they have any debt? What does that debt look like? Understanding their financial health is really, really important. And let's just say you're like, Elaine, I'm listening to your show because I'm not really clear on understanding financial statements. Consider working with an accountant or a financial advisor. We've talked about financial advisors. I definitely, if you have a financial advisor, definitely recommend you go through this process with them. Have them hold your hand while you're walking through this process, right? And particularly if you have a lawyer, that is going to be helpful as well. But go through this experience with as much help and support as you possibly can. So this is also the time when, and you might even want to do this in your screening due diligence of like, what's the market potential for this particular product or this particular company? Is there a demand? Is the demand going up or is the demand going down? How big is the market? We have something that we call in business school, total sizable market. Like what does the universe look like? And then what is the very, very realistic market share that could be gained or achieved with this business, knowing the size and scope and scale and talent it's part of the company. But you're also going to find out who are the competitors. A great product in a tiny market may not be the best investment. Maybe it is, maybe it isn't, but these are all the questions that you want to ask, right? So here's a tip. There are lots of great industry reports. I encourage you to talk to experts in the field. That's what LinkedIn is for. LinkedIn is a great resource. If you're like, hey, you can just send a question to somebody. You don't necessarily have to know them, but say, hey, I've got a question about what are the top 2 things that you're concerned about in the next 5 years in your industry? That'll give you some good information for a very low investment, not only of your time, but of their time, if you're really thinking about investing in a business. And you can even say, hey, I'm considering investing in a business in this sector. What are 2 or 3 things that you're most concerned about for startups? Right. And most people are very, very, very friendly. And if it doesn't require a lot of brain power on their part, they'll respond to you and give you an answer, especially a quick question like that, right? Or they might offer to say, hey, I'm happy to get on a 10-minute call with you. It's too complicated to get into a LinkedIn reply, but I'll get out, I'm happy to have coffee with you or something like that. But getting this information, libraries are also great. You can go to the reference librarian particularly at university or at the business school library, at the college or university in your community, and go to the reference librarian and say, hey, can you give me any information on this, what is the market or what's happening in this sector as it relates to this kind of product or this kind of company. They're super, super helpful. I can tell you my friend Adele at the Hennepin County Library, she is a wizard at finding me information. So use your reference librarians, okay? The next thing that you want to look like in this business due diligence is the founding team. So really taking a close look at, do they have experience? Or do they have the skills needed to execute the vision? Are they passionate and committed? And is a great idea really isn't anything without a strong team to bring it to life. Don't be afraid to ask tough questions. Get to know the founders, understand their motivations, and make sure that you feel that they're in it for the long haul. So now we're going to quickly go into like structuring the investment. Right now that you found a startup that you believe in and you've done your due diligence, it's now time to start structuring the deal. This is where things can be quite more technical, but don't worry, I'm here to guide you through it. So the first part is, do you want to do equity or do you want to do convertible debt? Right? And there is a difference. When you invest in a startups, there are 2 ways to structure the deal. Either straight equity means you're owning a piece of the company, or convertible debt. So I'm going to talk about each one of those very quickly. So investing in equity means you're buying a piece of the company. If the company does well, the value of your equity increases and you can sell it for a profit down the road. However, the company fails, your equity could be worth nothing. I have done that. I have invested in a small business, and after 3 years, things fell apart. I would say part of it was market, part of it was team, part of it was other situations, but that money was a loss. So when you're doing angel investing, there is a distinct possibility that you might be taking a loss. So you have to take that into concern. So give you an example. Let's say you invest $50,000 in exchange for 5% of ownership in the startup, or 5% equity. If the startup grows and eventually sells for 10 million, your 5% stake is now worth $500,000. So not a bad return on investment. But also remember, as I just shared with you, you could also lose that 50,000. So my grandma used to say, don't loan any money that you need back. So this is kind of the same thing. Don't invest any money that you're afraid to lose or you can't live without, right? So the next one, convertible debt. On the other hand, convertible debt is essentially a loan that can be converted into equity at a later date, usually during the startup's next funding round. This option gives you the security of a debt instrument, meaning you're going to get paid along the way while still allowing you to benefit from the equity appreciation if the company does well. Just here's a tip. Convertible debt can be a great option if you're investing in a very early stage startup that doesn't have necessarily a firm valuation of what the company is valued at. It allows you to delay deciding whether or not you want equity until the company has grown a little bit more. So the next thing we're going to talk about before we wrap up is valuation and terms. Valuation is the process of determining how much the company's worth, and it's a key factor in deciding how much equity you'll receive in your investment. So this is kind of what you'll need to use as part of your negotiating. As an angel investor, you have the opportunity to negotiate the terms of the deal. And so does the founder, right? But this includes things like the percentage of equity you'll receive, your rights as an investor, and any conditions that must be met for the investment to proceed. Don't be afraid to negotiate. Startups are often eager to secure funding, and you have the leverage to ensure the deal is fair and favorable to both parties. But here are some rights and risks. You make sure you fully understand your rights as an investor, when you can redeem the value of however your investment is structured, and whatever the risks are, particularly for the industry and for the startup itself. Many startups fail and you could lose your entire investment. But if the startup succeeds, the rewards can be substantial. Fun fact, did you know many angel investors also serve as mentors or advisors to the startups they invest in? It's a good way to put in not just money, but valuable expertise and guidance. And it's often what's termed as de-risking your investment. So if you're involved and you're engaged and you're giving them the knowledge and expertise of what you know, then they're far more likely to be successful. So really quickly, some practical and tactical steps. Number one, action step one, learn the basics of investment structures. Number two, start small and gain some experience. And three, network, and learn. That does it for this segment on the process of angel investing. When we come back, we're going to talk about managing and exiting your investments, how to stay involved with your startups when they want to cash out, and how to make sure you're getting the most out of your angel investing journey. Stay tuned. Welcome back to the Do Different Better show. We're wrapping up our deep dive into angel investing. In the last segment, we talked about how to find, evaluate, and structure your angel investments. It's now time to discuss what happens after you've made the investment. How do you manage it, stay involved, and eventually exit with the best possible return? So let's get to it. Okay, so you've made your first angel investment. Congratulations. But don't think your job is done just because you've written a check. Managing your investment is just as crucial and to maximizing your returns and ensuring that the startup you've invested in has the best chance of success. So, number one, there's active and there's passive involvement. First, you need to decide how you want to be involved in the company. And once again, I encourage you to do that before you even write a check, before you even think about looking at a company. Figure that out. As an angel investor, you can take a hands-on approach, or you can be more passive and let the funders run the show. The founders also have a say in this. Maybe they don't want a mentor. So knowing that, if that's how you want to be leveraged as an angel investor, is important so that you'll know whether or not it's going to be a good match. If you choose to be actively involved, you might serve as a mentor or advisor or take a seat on their board of directors. This will be particularly valuable if you have expertise in a particular industry. By offering your guidance, you're not just providing financial support, but you're helping to steer the company in the right direction. So then there's passive involvement. On the other hand, if you're a passive investor, you might choose to simply monitor the company's progress through regular updates and reports that they offer to you, or you can ask for as part of your investment agreement. This approach allows you to stay informed without getting too involved in the day-to-day operations. Maybe you travel a lot and you're not really available. It's not that you don't want to be involved or be more active, but your schedule or your commitments don't allow you to do so. But even if you choose a more passive role, it's important to maintain regular communication with the founders. Set clear expectations and updates for check-ins so that you're always in the loop. I would say that was one of the things that I learned from one of my first investments, is that I knew this person, and I wish I had said, hey, I want to check in once a quarter or every other month, and let's set up a time on the calendar where, even if it's 15 minutes, tell me the highs and lows of the business and how might I leverage my resources. So I definitely encourage you to write that into the agreement and stick to it, even if it's just a 15-minute call, that you schedule that and that it's on the books. 2, monitoring the progress. So whether you're actively monitoring things or you're passively, having regular monitoring of the progress is important. You need to keep an eye out on the company's performance, and there's a few different ways to do that. One is through financial reports. So one of the things that I tell the entrepreneurs that I invest in, many of them are using some sort of bookkeeping platform like QuickBooks or Bench or Wave. I tell them many of these platforms, they can send their financial reports to you automatically without giving you access to their account. So my founders, I receive monthly cash flow statements, profit and loss statements, so that even though I may not be able to talk to them on the phone, I'm getting information on a regular basis. The other way is monitoring their milestones and key performance indicators. Any company should have key performance indicator. What are they trying to achieve? When are they trying to achieve it? These are specific goals and metrics that the company aims to achieve, such as launching a new product, hitting certain revenue milestones, or acquiring a certain number of customers. So you can help work with the founders to establish clear key performance indicators, or KPIs, and milestones from the beginning. This way, you'll have a benchmark to measure progress against, and you can identify any potential issues early on. So now, in the last remaining minutes, I'm going to talk about how do you exit. And once again, this is super, super high level. I definitely encourage you to join a group, once again, like a Pipeline Angels, where they'll go into all of this in far more detail. And 45 minutes is not enough time. But we're going to talk about exit strategies. There are a few common exit strategies, and each with their own pros and cons. One, there's acquisition. One of the most common exits is through acquisition, where a larger company buys the startup. This can be a significant return on investment if the acquisition price is high. However, it depends on the buyer's evaluation of the company. 2, initial public offering, which is far less frequent, but it is another potential exit where the company goes public by listing its shares on the stock exchange. This can be incredibly lucrative, but also rare, and it takes many years, often 10 plus years, for a company to decide to go to IPO and have the structure in place to go to IPO. Then there's buyback by founders. Sometimes founders can buy back their shares either because they want to regain ownership of their company, or because they found another investor and that investor is requiring to buy out previous investors. This can be a quicker exit, but it might not offer the same returns as an acquisition or an IPO. This may be a way for you to avoid, a way for you to avoid some capital gains, and you've done an amazing job by supporting a company and to grow and scale in the short term. You definitely want to talk to your accountant as the part of the integrated capital fund. That's one of the offerings that we do. We make an investment so that they have an asset on their balance sheet, but we are setting them up because we are not necessarily trying to own a whole bunch of companies, but we want to move cash out the door to grow these companies. So we give them an opportunity to buy back the shares. Yes, there's a premium that they're buying the shares back from us, but they're able to buy back their shares. And that's really the underlying premise, as opposed to us making a 30x or 20x return on the investment that I make in them. The next really quickly is timing and patience. You've definitely got to know that if you're making an investment, it's typically going to be for 5 to 7 years. There are some mechanisms where you can do that in a 3-year term, like with the Integrated Capital Fund. We do 3-year terms for our investments that we make, but it is a smaller return on investment. So we're doing less than 8% return on investment, which is comparable, right? So, if you're looking at 7 to 10 years, you're probably looking maybe at a 5x, 10x, 20x return. But because our goal is really to just move capital and get these companies going, and where they wouldn't necessarily get capital, we're just trying to move capital and look for a modest return. But you also want to keep an eye on market conditions and industry trends. So that can have a huge impact on any particular founder. So once again, here are your action steps. Understand the exit options, build a diversified portfolio, and once again, stay engaged and keep learning. Remember, angel investing isn't just about money. It's about supporting innovation, creating jobs, and being part of something bigger than yourself. If you're ready to dive in and take your first step, do your research, make some connections, and start exploring the incredible opportunities of angel investing has to offer. And that wraps up today's episode about angel investing. Today, I broke down the basics of what angel investing is and why it's exciting. We talked about how to find and evaluate investment opportunities. And we also talked about structuring deals, monitoring, and how to walk you through exiting your investments and maximizing your returns. I hope you gained some valuable insights on how to manage your angel investments. Don't forget to subscribe, but don't forget to also join me next week, where I'm going to be talking to you about tips and tricks that the wealthy use to keep their hard-earned money where it belongs, in their pocket. We're going to talk about ways to lower your tax bill through your investments. Let me know what you think of the show. We love comments. Tell us how this has helped you. If there's a money question or finance question you have, or if there's someone you want me to interview, hit me up on LinkedIn or Instagram. Don't forget to hit the subscribe button. I can't wait to see you next week, and I'll show you how to do different better.